Dow building on its post-election rally as the S&P 500 nears a close of 6,000. Both indexes coming off their best week of the year with the Trump trade taking center stage. Our next guest growing more optimistic on the S&P 500, seeing a year-end target now of 7,000 for 2025. Yardeni Research President Ed Yardeni joins us now to discuss. Ed, is always good to have you on the show. So 7,000 for year-end 2025. Dr. Ed, what gives you that optimism? What gives you that confidence?
Well, I think we're seeing a emergence of animal spirits. It's very reminiscent of what we saw during Trump 1.0, when the stock market improved quite significantly when Trump got elected. And in addition, a lot of sentiment indicators really took off, like business optimism and consumer confidence also did extremely well. So I think we're just seeing a more pro-business administration coming in that undoubtedly will cut taxes, and not only for corporations, but also for individuals. Lots of various kinds of tax cuts have been discussed. And in addition to that, a lot of deregulation. So we're upping our estimates for what profit margin is going to be doing over the next couple of years. It's going to go higher. And that's leading us to conclude that earnings are going to be stronger than we had thought and drive the market up to probably 7,000 by the end of next year, as you said.
Ed, are there any variables, though, that you're more worried about with a Trump presidency? You know, there has been, of course, talk on the part of economists that if you do get a trade war, that could be inflationary, deportations could be. How much do you worry about that?
Well, I worry about all those things. It's just a matter of giving weight to the worries. I mean, we all have the same information. And the good news in terms of what we can expect from Trump 2.0 is that there will be tax cuts, there'll be deregulation. And oh, by the way, I think there might be some diminishing in geopolitical crises, particularly in the Middle East and between Ukraine and Russia, if Trump is successful in cooling off those terrible wars. So all that is good. On the other side, we've got tariffs that could be inflationary, could lead to trade wars. But I think to a large extent, Trump is, playing the art of the deal, trying to get set for pushing a lot of our trading partners to be more accommodating in their relationship and trade, less kind of leaving us with the short end of the stick. So I think it's a negotiating position to a large extent. I think deportation is going to be handled slowly. I don't think it's going to be mass deportation. I think it's going to start out with the really bad actors, and then we'll see where it goes from there. But I think there's going to be a lot of pushback for employers who are finding that immigrants have fit into their production and services. So I think, there's pluses and minuses, but I think on balance, the pluses weigh out the minuses.
Can I ask you, Ed, generally speaking, if investors seem like right now, they're not really worried about anything, is that actually a source of worry?
Yes, to a certain extent. I do have a sort of contrary streak, and I think you're right about that. But look, what causes bear markets is recessions, and recessions are typically caused by credit crunches, caused by tightening of monetary policy. For the past 3 years, we've been in this terrible recession that never happened. It was the Godot recession. It was the most widely anticipated recession of all times. And it made sense. I mean, the Fed raised the Fed funds rate from 0 to 5.25%. Surely we should have gotten a recession. I didn't think so, but that was the widespread view. And if we couldn't get a recession out of what just happened with the Fed for the past 3 years, now that the Fed is easing, why are we going to have a recession? Other than perhaps a geopolitical crisis leads to an oil spike. But even that hasn't happened. We've had geopolitical crisis and the price of oil's gone down. So I think the prospect is that I think investors are starting to feel comfortable that there might not be a recession over the rest of the decade. I'm not saying we'll never have a recession again, but that very thought means that higher valuation multiples today may very well be grown out of as earnings continue to increase.
That's really interesting, Ed, and you took me exactly where I was going to take you, which is to the valuations chart that was in your note today, where you make note of the fact that we've seen valuations go higher for every different group, whether it's small caps all the way up to the ultra mega caps, although obviously the mega caps are the most highly valued. So how do you think about that? In other words, what you're saying is you think because the E is going to come up, we're not necessarily going to see an explosion of PEs from here.
Exactly. Yes. Not only do I think that earnings are going to continue to grow, but I think they're going to grow maybe faster for longer without a recession. So again, that means that over time, if the price were to stay here with a high PE, the E would grow and the PE would come down. I agree. Valuation multiples are in fact stretched, but I think they are consistent with the view that the economy is going to continue to grow. When you look at that chart that we just looked at, obviously the market is focusing on the mid caps, the small and mid-size S&P 500 companies, the 600 and the 400, because those valuation multiples have been down and out for a while, so they're catching up.
Ed, one final question. This country's fiscal challenges, not an issue that either candidate really wanted to meaningfully address.
Correct.
How, for long-term investors who are watching this right now, Ed, how should they be thinking about that?
Well, I think actually Trump has addressed it by appointing Elon Musk to work on cutting government spending. Musk does a great job of that in his companies. There's a great biography that came out a couple of years ago about Elon Musk, and he's a real cost cutter. The question is whether you can do it in the government. It's one thing to tell people that work for you that they've got to cut costs, and if they don't, you fire them. It's a whole different story, perhaps in the government. So we'll see how that plays out. But there's certainly an understanding that government spending, at least the pace of increase, has to be slowed. The question, of course, is revenues. And I think we're kind of back to the old Reaganomics idea that if the economy grows better than expected, that's going to grow revenues better than expected. And I think there's something to it. Even before Trump got elected, I think we were seeing productivity growth really improve. And I think the prospect is that economic growth is going to solve some of the problem. But at the end of the day, we probably still need a political solution. We still need a grand compromise to slow the pace of spending and to increase the revenues that are available. And I think, the Republicans have screwed up this opportunity before where they were in charge. Let's see if they get it right this time.
And I just wanted to drill down on one part of what you were talking about there, which is the Elon Musk factor. Sure. As an avid X user at one time or another, we know he cut a lot there as well. And the thing doesn't always work too well, seemingly as a result of that at various times. The stakes, one could argue, might be higher in certain parts of the government than they are with people posting on a social media platform. So,
right.
I've heard a lot of people talk about this idea of the Musk effect on government, that it would be a good, right, a positive. Mm-hmm. But what about the risks there? Well,
look, if we're talking about Elon Musk having more influence in the public sector as opposed to the private sector, or just more influence on what this administration does, clearly he doesn't always get things right, and sometimes he promises things that he can't deliver. So that may be an issue with regards to the spending cuts. But look, I think he's bought some time here in terms of a potential debt crisis. The bond market isn't going to know exactly where this deficit situation is going to go for a while. And I think it's conceivable that the bond market will give this administration the benefit of the doubt and assume that they will do something about cutting spending and that they will do something about finding sources of revenues. And maybe it'll be growth, but clearly Trump is talking about using tariffs as a source of revenues, at least that 10% tariff that he intends to impose. So we'll see. Nothing's guaranteed here, but I think the outlook is brighter. I think the stock market discounted a lot in terms of the profit margin being boosted by a tax cut, and I think that's a good move that makes sense.
And we'll definitely be watching that and the bond market very closely. Ed,
Sure.
Always great to catch up with you. Thank you so much.
Thank you.